ESG and sustainable finance. What's happening and where is it heading? ESG and sustainable finance is certainly an increasing focus for a lot of banks in their lending policies. So looking at the actual transactions that have come to market, do you see any particular trends?
Yeah, I think probably what I'd say on that is the one consistent thing about ESG finance is that it's inconsistent. There's essentially no templates, no precedents. Almost kind of every deal is bespoke. And that's a function of a couple of things. First of all, the market is still very much evolving. So if we look at what the situation was 4 years ago, was when the first sustainability-linked loan was actually put in place. So it's really been in 4 years' time we've seen it go from zero to about $1 trillion worth of sustainability loans in 2020. And I'm sure 2021, when the figures come out, will be even higher than that. So the market is still very much evolving. And every company is different as well. A lot of ESG loans, if you're lending to a company, it'll have a very different set of features. There'll be a lot of different opportunities to actually improve the ESG rating in those companies. So every deal is different. Every deal needs to be structured differently as well, is what I'd say.
We're hearing a lot about sustainability-linked loans. Why would a borrower choose a sustainability-linked loan over a green loan?
Sure. Well, they're two very different products, in fact. So taking each in turn, a green loan, first of all, the focus in a green loan is the use of the loan, the use of the proceeds. So when you borrow a green loan, you have to actually apply that loan to certain green projects, and that can be environmental infrastructure like renewable energy. It can also be some other things like to improve your farming. If you're a dairy business or a farming business, you might want to improve your sustainability and the way you farm. So the green loan is very much geared towards the proceeds of the loan and seeing how they're used. And that came from the green bond market, which really took off in about 2007 or so, was when the first green bond was done. And we've seen then banks take that and then move into green loans in the last few years as well. And to be clear, green loans are nothing new, of course. Banks have always been lending to renewable energy products, for example. But it's been in the last few years that people have really started to brand them as green loans. So green loans are kind of activity focused, if I can use that word. Whereas a sustainability-linked loan, or SLL, is behaviour focused, if I can use that. And the difference is, for an SLL, there's no restriction on what you can use the money for. So often SLLs are just used for general corporate purposes, for any kind of use the company wants. But an SLL focuses on changing the company's behaviour and improving certain ESG metrics that the company is using. And typically that's done by the company getting a reduction in their margin, a reduction in interest rate if they meet certain ESG criteria. And those can vary. They can be environmental, social, governance criteria. Of course, the big one being environmental. That's what most SLL loans tend to be focused towards. And that can be something like reducing the company's carbon emissions. So if the company reduces their carbon emissions, they get a discount on their interest.
What are the main issues when it comes to structuring SLLs?
So I suppose the key issues structuring an SLL, well, as I say, there's no real template in the market. There's no real precedents. There's no sort of defined list of what an SLL should be. So it's still very much open to interpretation. And in fact, actually, the regulatory industry bodies have been quite active in this space, especially over the last couple of years. So the LMA, APLMA, and LSTA, which are the three industry bodies for loan markets, produced a joint set of principles over the last couple of years and refined them recently. And they set out the kind of five main things you should expect to see in an SLL, which include the sustainability performance targets, or the SPTs. So an SLL should set out those very clearly. They should be identifiable, they should be easy to measure, and the company should report on them. And probably two issues I'd pick out. Number one, transparency. Two issues in transparency and reporting. So the regulators are very keen, and the industry bodies are very keen on making sure that the targets are genuine targets. The phrase that comes out a lot is they've got to be ambitious and meaningful. It's very easy for a company to actually have a target in there that's something they're doing already. And that's not really the idea of an SLL. The idea of an SLL is to get the company to actually change its behaviour and to improve its ESG performance over the life of the loan. So the question of whether an SLL is actually helping to improve ESG or not is something that people do struggle with. And so probably my 2 cents is that'll be something that people will be very focused on over the next couple of years. There's talk of greenwashing, which essentially is kind of dressing up a loan and saying that you're branding it as an ESG loan, but actually it's not really pushing the company to improve its environmental performance as well. And I've heard it said before, if there's one thing that's almost as common as ESG loans, it's greenwashing, because a lot of loans, you've got to make sure you've actually got meaningful and transparent targets. So that's point one. And the second point is the reporting aspect as well. So typically in an SLL, you'll have an external company that's actually doing the reporting, that's looking at the company's data and saying, right, how have you actually improved your ESG targets over the last, over the life of the loan? Now, that's something that companies do very much really need to get involved in. They need to actually get an external person to come in, check those metrics they've got, and then tell the lender whether they have actually achieved them or not. Now, a lot of companies struggle with that a bit. They'll sort of say, well, actually, by the time I'm paying someone to come in and do all this research and collect all this data, the discount I get on the margin, the discount I get on the interest rate, actually cancels out all the money I have to pay this person to come in and look at my data. So that's been something that people do have to get their heads around. And again, that's something I think probably going forward will be a focus of people in terms of how independent are those certifiers, and what kind of data are they using to make the decisions.
KPIs and sustainability performance targets may differ depending on the borrower's industry or business. Are you seeing any trends in what KPIs or SVTs are being selected?
I think, again, there's a broad variety in the market. And in fact, taking the 3 letters ESG, what we tend to see is about 70% of loans are focused on the environmental aspect. So there's some kind of environmental target the company is looking to hit, and very often that can be greenhouse gas emissions, GHG emissions. The company just has to reduce those, and then they get the discount on the margin. About 20% then are based on social factors, and that can be things like improving their employee health and safety, or improving their diversity and inclusion initiatives, for example, the diversity of their workforce. And then about 10% is governance as well, so the remaining 10%. I suppose with governance, what I hear from a lot of lenders is we wouldn't really lend to a company that didn't have good governance anyway. So we can't really sort of improve their governance because it already has to be good for us to lend to them. But I think probably my 2 cents is over the next year or two, we may well see that social aspect becoming more and more prevalent, only 20% at the moment. And I think that will be a lot of focus there on things like employee health and safety, diversity and inclusion initiatives, because that's something that a lot of companies are working on actively at the moment. I think if they can then work with the lenders to structure an SLL that verifies that, that'll be something that we see a lot of companies doing.
How's the market for green loan progressing?
Yeah, that's also progressing relatively strongly as well. And we've seen a big increase in green loans over the last couple of years. Again, as mentioned earlier, a lot of lenders, of course, have always been lending to green projects. They've always been providing finance for renewable energy products or for transport infrastructure. So really the question is, are you actually branding your loan as a green loan or not? And that's been something that has grown a lot over the last couple of years. And in fact, I remember working on a transaction for a wind farm where actually the first round of the wind farm was just a sort of standard loan to construct the wind farm, and the second phase of the wind farm, it was branded as a green loan. Now actually the wind farm was exactly the same, but the relevant borrower there just said, well actually there's a green loan kind of label I can stick on my loan, so I'll just apply that to this phase too. But as I say, so banks have been doing this for years. Having said that, certainly green loans are growing in the sense that a lot of banks are actively looking at this and saying, well, look, let's try and brand our loans as green loans and let's measure them and let's actually get some performance metrics on the loan so we can verify that the loan is going to these green purposes. And that's good for us and it's good for the borrower as well. And it's, again, something that both borrowers and lenders are very keen to do because, of course, it's good reputationally. It's good in terms of the bank and them being able to actually monitor where those proceeds are going and have an independent person potentially confirming that's what's been done. So again, the trend is upwards for sure.
How is something classified as a green loan, and are there any more contentious criteria that are harder to satisfy?
Yeah, it's a good question. And again, the issue with this is that, as I say, green loans have been going on for years, really, and it's really a question of, yes, who's certifying it and how do you actually sort of confirm that the loan is being used for a green purpose. And we have seen a lot of activity sort of on that point over the last couple of years. So there are various people that can sort of certify green loan, can get an independent certifier in to actually say that, yes, the loan is going to these purposes and we confirm it's for this green purpose. And there's guidance, again, produced by industry bodies to say, in order to really brand something as a green loan, this is what you should be doing. Now, I think over the next couple of years, my prediction for sort of 2022 and beyond is really start to see the regulators coming in and saying, this is actually what you need to do in order to brand your loan as a green loan, and you can't market it as a green loan unless you do this. So the EU, for example, is actually leading in this space with their taxonomy regulations. And I think certainly in APAC as well, we're going to see a lot of regulators, the HKMA, for example, the Australian regulators here, will be very focused, I think, over the next couple of years in terms of making sure that a green loan is actually going to a green purpose, and making sure people are verifying that and getting that confirmed officially.
What do you think the areas of focus would be for sustainable finance in Australia in the future?
Well, I think certainly the trend will be upwards. If you look at what's happened over the last couple of years, it's on an exponential curve upwards. So I think we're going to see a lot of growth in the market over the next couple of years. And I think probably my 2 cents is for 2022 and beyond. Number one, I think we're going to see the regulators really getting involved. And we've seen that over the last year or two in the EU, for example. They're one of the leaders in this space, the HKMA as well, and the Australian regulators too. There'll be a lot of regulatory activity trying to really codify some of the things that the private market's been doing. And there's some difficult questions to answer, for example, like with a green loan, should that actually go to a nuclear power plant, for example, because that's a low carbon energy source. So can you actually brand a loan for a nuclear power plant as a green loan? So there's various questions that the people are still trying to get their heads around and work out, both on the green loan side and on the sustainability linked loan side as well. I think we'll probably see a bit of a convergence. At the moment, everyone's, as I say, kind of doing their own thing, and there's no real sort of set formula for how these things work. So we may well see some convergence in the private market, and I think overlaying those regulatory issues as well. That'll be something definitely to watch out for over the next year or two.